Hi, I'm Jenny Brown. Welcome to this week's MFB news. What a week, eh? I don't even know where to start. I was thinking the other day about, as a nation, how interesting it is how our vernacular has had to kind of evolve. So I feel like for a while we all became epidemiologists during COVID. During the kind of all the talk about the cost of energy going up, we all brushed up on our kilowatt hours, and now we're all becoming also mini economists. We're all starting to learn about swap rates, gilts, and also inverted yield curves. So if nothing else, we've certainly had to brush up on lots of knowledge. Now I've been trying to think about the best way to kind of run through what's been going on with you, and I think when I'm going to break it down like this, I'm going to talk to you about what's been happening with lenders. I'm sure you'd have seen the press, and I'm sure you're all kind of very aware of at least some of this, but I'll give you the kind of view from the broker rather than from the press. No headline grabbing here, and what to expect going forwards. I'm going to tell you what's been happening with pricing, what's going to happen going forwards, and then I'm just going to try and give you some thoughts in terms of what you can do to kind of shore up your position and potentially how this is going to impact landlords over the coming weeks, months, and even actually years. Okay, so a week ago today we had the mini budget where there were some announcements, which largely the ones about the tax cuts, the ones that sent the markets into a frenzy. Essentially, as a country, we're going to be borrowing more money, but we don't have any defined plan as yet about how we're going to repay that. The markets went into absolute meltdown. The pound tanked against the dollar. It went as low as $1.03 to the pound. And things kind of got really ugly. Swap rates jumped up and were bouncing around. So they went from kind of 3.2 up to a month ago to over 5%. And at this point, lenders were kind of sitting there looking at the swap rates, not really sure how to price their money because there was so much movement up and down, sometimes of over 0.5% during a matter of just even half a day. So one by one, the lenders have looked at the pricing models and realised how incredibly hard it is to have a product set on the market, particularly if you're having to remove it every 5 minutes. We've seen a lot of very quick rate withdrawals over the last few months. I've talked about this many times. It's not good for anybody actually to have lenders bringing rates on the market and putting them back out again, sometimes even just a couple of days later, because it really means that brokers will flood the lender with applications, their service proposition falls over. There's always going to be clients who simply, or borrowers who can't get to the application quick enough. They come away feeling disappointed. And it's just a very bad environment to be in. And I think the lenders, having been dealing with this anyway over the last few months, didn't fancy carrying on when things have entered an even more volatile phase. So that's why you've seen a bunch of them withdraw their fixed rates, not just 5 year, 2 years as well. And we'll come on to why that is in a minute. But really, what I would say, and the message is very strong, and this isn't just my words, we have lenders phoning us up all the time, restating kind of their situation. It's not they don't want to lend money. It's not they don't have any money. They have a real appetite to lend money. They want to lend money. They've got money to lend. It is purely that because of the volatility of pricing, they've had to step away. So in terms of going forward, what does this mean? So actually, even as of yesterday, we've seen the Mortgage Works return to market with pricing. Now, the Mortgage Works is a really large lender, buy-to-let lender in the UK. It's owned by the Nationwide Building Society, so it's backed by a large kind of institution. So when a large lender like that comes out with pricing, that's really reassuring, because it means that other lenders are going to say, well, okay, if Nationwide are comfortable, we can be comfortable too. So Nationwide brought some rates out yesterday. We've also seen other lenders reprice where some didn't actually go away. So we've had lenders like Barclays, RBS, continuing to have a 5 year offering, the Coventry as well, all the way through this. But we've seen various repricing going on. So the Mortgage Works rates, just to kind of give you a flavour of what's coming up. So their 5 year fixed rates are now starting from 5.74, 2 year fixed rates from 6.04, and I'll come on to that in a moment as to why there's such a large difference between 2 and 5 years. They've also got some tracker rates, and this is an interesting one, and we're having more and more conversations. I know I've talked about this in previous weeks with people about trackers. 2 year tracker from 2.39. Worth consideration, isn't it now? In terms of where lenders like Barclays are sitting, so they've actually got 2 year fixed rates from 3% and 5 year fixes from 3.1. So actually, with terms of the pricing that's starting to sort of fall back out, it's not a total disaster by any means. Obviously, 5.74, way more expensive than some people are going to want to pay. But actually, at least there are options. Now, we haven't seen the really specialist lenders come back yet. I think that's something for maybe a trickle later on today, but more are going to come out early next week. There were a couple of lenders who took the decision to, rather than stop offering fixed rates, to actually reprice and continue with the product set. To sort of give you a flavour for that, pricing of over 7% was coming to market. So we are hoping that when we see more lenders come back in next week, where they've kind of taken that pause and had time to kind of readjust things, we should see rates lower than this. But that's kind of where the pricing was coming back in over the last few days. So that's what's been happening with lenders. So in terms of pricing, so really kind of just to kind of go back to what we were saying. So to give you a kind of flavour about the movement of the interest rates. So on the 28th of September 2021, so 1 year ago today, 5-year swap rates were at 0.72%. On the 30th of August, so 1 month ago today, swap rates were at 3.271. So you can see already there's been an over 2.5% increase in terms of 5-year costs year on year. What happened on Tuesday morning is swap rates jumped up to 5.215%. So that is a 2% increase in the matter of a month-on-month sort of comparison. Now on Thursday, 5-year swap rates had eased back down to 4.883. So that's really, really encouraging. So it does show that actually things are showing some signs of stabling. No doubt, thank you very much to the Bank of England for coming out and buying a bunch of government bonds and really calming things down. And this can be reflected in what's happened with the dollar as well. The dollar went down to as low as, I think it was $1.03 to the pound. Last night I had a look, this morning rather, I had a quick look, and it was at $1.11 to the pound. So actually things have started to kind of, I wouldn't say rebound or recover, but things are certainly feeling a lot better than they were at the start of this week. So in terms of pricing, what are we looking at? So it's really difficult to call actually. I do have a sense that actually swap rates went through a reaction to the mini budget. I do think things are going to calm down. So I do think that actually there is a potential that maybe interest rates that come online, which are pricing against swaps, this is your fixed rates, are going to come out at a certain level over the coming few days. And there is the potential that as swap rates potentially steady, and there's no guarantee they will steady because no one's feeling exactly excited about the quasi-Kwarteng Liz Truss administration at the moment. But if the market can get comfortable with what's going on, once they reveal the kind of plans behind their budget, then we may see swap rates ease. Conversely to that, what we've also got is a talk of Bank of England base rate going up, a potential emergency budget meeting being held before the next proper meeting in November. When we're speaking to people, the general kind of consensus is that whether it's in October or whether it's in November, we're expecting an interest rate increase of at least 1%. So what you may actually see is a kind of balancing, and swap rates and fixed base rates aren't actually inextricably linked, but you might see that swap rates ease off, but then we see base rate move as well. So things are going to be doing this for the coming weeks. So I think in terms of what to expect with pricing, so you would have seen in the news that there's an expectation that base rate would have hit 6% by the middle of next year. I think really the messages just can only ever be to you that interest rates are going to go up. So I wouldn't be rushing to take a fixed rate this week. I think that there are more rates to come out. Don't panic, hold your nerve a little bit here. More fixed rates are going to come out over the coming few days, and they will come back. So please don't worry, there are going to be fixed rates. There's going to be lots of fixed rates. They're going to feel more expensive than we're used to, but they are going to come back. I wouldn't rush to secure something this week unless it's those very low kind of Barclays rates at 3%. NatWest rates, because I think they probably will go up. But if you're looking at kind of rates at 5 point something, I'd probably just kind of hold off for now and wait and see what next week brings before you make any large decisions. So what does this mean for landlords? Look, we're speaking to landlords all the time at the moment, and they are really worried. Of course they're worried. Who would want, or who would be comfortable with the idea of your mortgage costs going up by 100%, even more in some cases. So there are some very, very anxious people out there. I wanted to just provide some context actually. So I've been at Mortgages for Business for over 15 years now. So I joined just before the credit crisis, which was obviously pretty terrible timing on my part. But actually, when I joined, base rate was at 5.75%. And we were seeing well, the same sort of business levels that we see now, actually. You know, I think the market's kind of moved on in various ways in certain terms of, you know, some landlords have divested and maybe there are less landlords in the market now than there were then. But actually landlords were borrowing at those kinds of interest rates and were quite comfortable. You know, I've got clients who recently came off 5-year fixed rates of 5.8, 6%. Obviously they've spent the last, you know, few years been incredibly frustrated because of the lowness of how interest rates have gone. But actually these guys, you know, landlords have paid these kinds of interest rates in the past and they have survived. What we've also seen is an increase in rents over the last year. You know, I've been mentioning, I think it was figures of rents increasing across the board by circa 10%. And there is an expectation that, you know, landlords will pass on at least some of these increased borrowing costs onto the tenant. You know, it's really unfortunate for the tenant. But this is what will happen. It's what always happens. So I think there is a kind of, you know, almost to take a breather, you know, just come away from just the higher mortgage interest costs for a moment and just really kind of consider the bigger environment here. So in terms of what you guys can be doing to shore up your position. So first of all, I will say the same message that I've been saying to you for, I think it is months now. If you have a mortgage rate that's ending in the next 8 months, now is not too early to look at booking in a new interest rate, okay? We can sort of find various lenders who have long offer periods. So that's your first kind of comment. If you are about to move on to a lender's standard variable rate later on this month or next and you are panicking because mortgage applications are taking quite a long time to go through and you won't be able to secure a new fixed rate in time, give us a call. We have really quick access into lender systems in terms of product transfers. A product transfer is where you literally, on a like-for-like basis, so no capital raising, transfer the rate you're currently paying with one lender to the same lender. You just kind of switch rates internally. Now, these are an absolute godsend, particularly for people who have left it to the last minute or even left it beyond the last minute, so now on standard variable rate, because there's no underwriting, there's no legal process, generally speaking. So what happens is we can literally go onto the lender system, key in some details, it throws up a bunch of fixed rate offerings. We'll come back to you saying you can have any one of these, and if you pick one, we can get it done, and it generally clicks in almost instantly, so it's really, really fast. So if you're in that situation, give us a call. Now, for those people who are having a bit of a panic, and I'm going to put myself in this category, so just to give you some context about how unfortunate timing can be. So I have 2 buy-to-let mortgages, both of them end in December next year, which I think is probably when we're going to largely be at the peak of interest rates. The reason I say that is because when you look at 2-year swap rates, 2-year swap rates are much higher than 5-year swap rates. This is because there's what's called an inverted yield curve. So essentially the cost of 2-year money is higher than 5-year money, and if you look at swap rates, it's literally I'm going this way on the camera, aren't I? So interest rates over 2 years are the highest, and then they come down over 10 years. So really things are expected to peak inside of the next 2 years. So I'm really happy that my mortgage comes off right in the middle of that, and I won't be alone on this. So we are having some conversations with borrowers who are saying, well, look, you know, I'm locked in for more than 8 months' time. I can't sort of benefit from getting one of these quick mortgage offers. What can I do? And these people are actually now really starting to reconsider the possibility of breaking their mortgage rates early and paying early repayment charges. Now, I'm not going to advocate this and say this is absolutely what you should do, but it's definitely worth at least considering it and doing the maths on it. For some people, this will make really good sense. Some early repayment charges are like 1% of the loan amount. So there is a real school of thought that for you guys, breaking the deal early could be really good. For those people where you're looking at like 5%, probably not going to be as beneficial. But again, we don't charge for conversations. Give us a call. We can chat it through with you. The other thing that we've kind of touched on earlier is tracker rates. We haven't really, as a business, sold many tracker rates for a long, long time because people have been really big into fixed rates, partly because interest rates have been so low, so taking a low fixed rate is fantastic, but also because you know, the rental calculations lenders use are more generous on 5-year fixed rates than they are on 2 and 3-year fixed, and also on variable rates. So we haven't been doing a lot of tracker rates. However, the conversation, the dialogue is really, really starting to change now. And when you consider that the Mortgage Works have just released a 2-year tracker at 2.39, a 2-year fix at 6.04. I mean, there really is a school of thought which is actually, you know, if I don't think I can afford to pay those really, really high interest rates, am I going to be better off taking a 2-year tracker at 2.39%, accepting that actually that is going to go up over the 2 years, but actually I don't think it's going to go up sufficiently so that I'm going to be worse off. There's definitely something to be had there. I think that the key messages at the moment is that you really need to kind of understand your options. I think that's really, really important, is just to lay everything out on the table and be able to make an informed decision. So more so than ever, actually, if you do want to have a conversation with us, we are very, very happy to chat with you. 0345 345 6788. Like I said, we don't charge for conversations. We will send you quotes, we'll go through your portfolio, review it for you, look at the ways you can save costs. There's no charge for doing any of this, so it really cannot hurt. So please do get in touch. Okay, so that's largely it for me this week. Sorry it's not a better news story, but actually I think there is some good news in here insofar as that actually there are going to be fixed rates coming to the market. So please don't worry, we're not going to see that there's no mortgage offers, no mortgage lenders at play. There's going to be fixed rates available. It might be more a higher interest rate than we're used to paying, but actually the way that the rental calculations are done, margins are already built in. People have factored in the fact that interest rates go up. So in theory, things actually should remain affordable. It might eat into the kind of surplus that we're used to. It might not be pleasant for us, but I don't think for the vast majority of people it's going to mean that we actually can't afford our mortgage payments. Now, if you are in a situation where you are financially struggling, there's a couple of things that you can do. So the first port of call, if you're not going to be able to meet your mortgage payments any month, the first thing you need to do is call your mortgage lender. These guys are under real obligation to support you in any way that they can. It's not in their interest to be difficult. So that's your first port of call. But likewise, you're very welcome to also give us a call and we'll be able to talk to you around your options and how we might be able to help you with that as well. So let's hope I'm here again next week with lots of shiny new interest rates. Hopefully some of them will be feeling quite appealing, but we will come back to you with a kind of full update same time again next week. Until then, look after yourselves and do get in touch if we can help in any way.